Hello everyone, Dr. Stock here. What a crazy day to watch in the markets. Looking at where they closed, the S&P, I was enthralled watching it all day. It closed just under 4,000. So does that mean that support is broken for the S&P? We'll talk about that in this video. We'll also mention Home Depot and Walmart. They'll come up in there, and also the federal funds rate, the bond market, just a little bit on the bond market anyway. Well, I just think it puts us at, once again, an interesting time in the markets, and we want to know where exactly the new direction is from here, or do we stay on course and we keep on dropping from where we're at? That's what I want to talk about in this video. If you want to hear more of my commentary or see more of my products, services, or just interact with my community in the private Discord, check out my link for the Patreon down in the description. I promise you won't be sorry. Just click the link, go on over, sign up, and please come join us. We'd love to have you over there. All right, with that said, let's get right into it. All right, so looking at where the markets closed, I'm kind of reminded of a video that I made last week where I said that the SPY could possibly give up about 2% and that the Qs could also give up about 2 to 2.5%. And I looked today at the close, the SPY down 2%, the NASDAQ down 2.5%. It was kind of cool to call those prices. And, I smile because hey, I was right. And it's nice when things work out. And that's the name of the game, is trying to be right at least most of the time. And I'm right some of the time. Most of the time on some things, definitely not all the time. Man, oh man, have I been wrong before. For instance, I was wrong about the timing. I thought that we would have seen it last week. Instead, we see it this week. And, well, we'll take a look at the charts and we'll see if it's something that's going to continue for us. And we'll talk about some of the catalysts that we have also. But I do, for right now, want to concentrate on the charts, and then we'll get into some of the other stuff. So here we're looking at the SPY, and it's just a good looking chart. I don't even need to put the blue lines on here, that the crosshairs that follow, showing the date and the prices and everything. Look at that orange line that we have going right across the middle. That's about that 4,000 mark for the S&P. It's almost the $400 mark for the SPY. And we knew that that was going to be an area of support. That wasn't really a hard call. We've actually stalled out there numerous times before. Now, let's zoom in a little bit, because you can see the candle sitting right on it. Today is my wife's birthday, and that's like a red candle on the cake right now that we're taking a look at. And let's just hope that it doesn't get lit on fire. Does it still count as support? In my opinion, absolutely. If we open up tomorrow below 4,000 and we close down below 4,000, then we can say that support is broken. Then it acts as an area of resistance for us. Down just a little bit from that, we have the 50-day. Down below that, a little bit more, is the 200-day. And I think that in the near term, that's what we're going to find as support for the S&P, assuming that we don't get a change in direction this week. So things that we have coming up this week, we have the Fed minutes, we get the second estimate for GDP, we get personal income and outlays with the PCE, and that PCE being core inflation. We want to look and see if it comes in at 0.3. 0.3 would be okay. 0.2 would be wonderful. We most likely end up green. Almost most likely enough where I'd say a guarantee, because it would break the narrative that we had coming from CPI, PPI. I just don't expect it. I more expect 0.3 or 0.4. We'll watch and see what happens. I still think that this week is going to be a red week for us. However, that video for CPI for February that comes out on March the 14th, I made that video already. It's a Patreon exclusive. You can go over and check it out. You can also check out my spreadsheet that I have attached to that, and you can play around with the numbers if you want to. Like I said, link down in the description if you're interested. Moving on from there. So March could be a different story for us. This is our last full trading week in February. Next week starts March, and maybe, just maybe, after a little bit more of a sell-off, maybe we even hit as low as that 50% retracement mark. Honestly, I still think it's more likely to going to be the 200-day moving average that I have on the chart here in front of you. As long as we don't cross past that 50% retracement mark, I think that we could start marching back upward from there. We're just going to have to watch and see as that plays out. And it would be really helpful to have information to the contrary that says that inflation might still be around, not as much as we thought it was, and that the economy is slowing down a little bit more, where we actually see a little bit of weakness in the jobs market. Things to convince the Fed not to continue to tighten as much as we think that they will, which right now is currently priced in at 3. That's right, 3 25 basis point hikes over each of their next, well, one over each of their next 3 meetings that we have. So March, May, and June. And then holding steady there for a while, although it could possibly go higher. That's something to pay attention to. We'll just have to see. But right now, 3 are priced in, and we'll see how it continues to treat the market from there. So I just wanted to share this article with you quickly from the LA Times. Wall Street weakens as higher rates keep tightening squeeze. So some of the pieces of this are interesting because there are things that I've talked about before on my channel, and there's a few things that I've talked about in my live streams with Stock Moe. Either I talked about it, he talked about it, or both of us talked about it. So if you haven't watched those live streams, the next time that we do one even, just keep on the lookout. Either subscribe to my channel, his channel, and you can check it out because we both host on our channels, and we'd love to see you there. So in my last video, I talked about Home Depot and Walmart and being very telling for what we have for the state of the consumer coming out of 2022 and moving into 2023. And the forecast fell short of Wall Street's expectations, like it says in this last line here. Home Depot is going to spend a lot more cash, $1 billion on wages, and they had a rough day today. I think they closed like 7% down. Walmart actually closed up, and I think it was just over 0.5%. I don't have that number in front of me, but they did give soft guidance for this year. So they do see a slowing down for the consumer, and that sort of has to be good inflation news in my opinion. So we'll have to watch as that plays out. It could also be further weakness for shelter. So maybe that lagging indicator that we have that's janking up the CPI, PCE, maybe that's something that finally gives us a little bit of hint of pulling back from that as we get into that second half of the year. Honestly, I think June, July, is our sweet spot, the really true turning point for this market. So we'll see if the market beats me to that and it happens earlier, or we'll see if the market lags that and it happens later. There is other things to worry about that are in this document though. So those earnings give us indications about the consumer and about the housing market and homeowners. Those are things that we absolutely want to pay attention to, and the market definitely paid attention to them, and part of that was the market reacting. This article goes on to say that several reports have recently come in to say the economy were stronger than expected. I'm sure they're referring to the jobs report that we got, and that also the CPI, PPI, and the upcoming PCE, I think, is going to tell a lot of the same story. And then moving on from there we go, moving down, here we go. Besides dragging on prices for investments, higher rates also slow the economy by making borrowing more expensive and raise the risk of recession down the line. And in my live stream with Mo, we talked about early in our live streams, the earliest live streams that we did since I've come back to YouTube this year, we talked about, Q1, possibly Q1, Q2, Q3 more likely. In our more recent live streams, both of us have changed our point of view to be Q3 or Q4, and then we have here about pushing the rate of the risk of recession down the line, so possibly late 2023. That's if we hit it at all. This next line I don't totally agree with. It says that caused the more pessimistic investors. I don't really like that they chose the word pessimism about keeping forecasts for a recession, but move timing later into the year. I don't know that I'm being pessimistic. I'm not trying to be a Debbie Downer, glasses half empty kind of guy when I look at this. What I'm trying to do, and why I bother talking about it here, is that I want to prepare, and I also want to bring that idea of a possibility to people's minds and just try and shed whatever light I can on the timing that I expect, and see, as you do your research, do you see the same thing? Do you think we're going to hit a recession? Do you think it's going to be that we don't actually end up going negative on GDP, that we just get an economic slowdown? So those are definitely things that we want to pay attention to. And when you use the word pessimistic, it makes it sound like, all out bear. No, with rates as high as they are, with inflation running as rampant as it has, even though it might be moderating, but at higher levels now, that's still prices going up, and it's still going to affect the consumer. And if the consumers expect those higher prices, well, then they start saving, they don't spend as much, and we get economic slowdown. And we can also see if companies' earnings really start to shrink up and they lay people off, that's also something that can slow down the economy as well. So there's a lot of evidence to suggest that a recession is possible, and I would rather be prepared for it, not pessimistic about the market. I think that there's a big difference. I think overall, I'm very optimistic about the market, that over time, it's going to go back up, given enough time. And I also want to be ready for when it does. And I also want you to be ready for when it does. So how I do that is by looking at the evidence that I have in front of me. And I think something like student loans, when the moratorium ends, I think that's going to be another huge drag. And we're going to see a much steeper drawdown in the economy than we really expect. I think there's a lot of reasons that we want to be optimistic, that we want the market to keep rallying upward, and I feel it too, because I absolutely love watching my long positions in my portfolio go up. I mean, I have a pretty healthy short hedge at this point in time. Sort of paid off nicely right now. I think it might pay off. If we hit that 50% retracement mark, I'll probably cash that out and ride the next little wave up in the short term. But that doesn't mean I won't take one out again as we near earnings seasons for Q1. I mean, we'll watch it take place. And, I can't give any sort of long-term prediction what I do with my short-term trades because the market is always changing. Circumstances are always changing. I can just tell you what I currently have and what I currently plan to do given the present circumstances and what I believe is going to happen in the near future. So let me summarize. I see the markets closing lower this week than what they opened. And you might say that, well, that sounds easy given what we've already seen in the markets today, down 2% in the S&P, down 2.5% in the NASDAQ, 2%, by the way, also in the Dow Jones. I didn't mention that before, but I should mention it. But I think that there still might be a little bit for the markets to give up from here going into the end of the week. And that could set us up a little bit more decently to start March out, maybe even into the middle of March. Maybe even March is just a good month for us in general. I have my CPI projections for February 2023, at least preliminary ones, available over at the Patreon, which you can find that link down in the description. Just click it, come on over and visit. We'd absolutely love to have you as part of the community. Keep watching those economic reports as they come out. Keep watching these videos as I talk about those economic reports to give you my take on it. And I hope that you find these takes enlightening and helpful. And just let me know down in the comments what you think. Is there anything that I left out? Is there anything you liked about it? Do you have a different perspective? Please let me know down in the comments. I'd absolutely love to hear from you. Thank you guys for letting me have your time. Just a few free ways you can support the channel. Click that like button, hit the subscribe button, and ring that notification bell to see anytime that my videos come out. There's a few other links down in the description if you would like to help yourself out while simultaneously helping me out. So we both get paid and it's a win-win. Check those out. And the last thing, as always, I'm Dr. Stock, Doctor of Education. We'll see you in the next video.